This is the subprime mortgage crisis from the investment banker viewpoint. My name is Alicia Richter, and I hope you enjoy. When we think about the subprime crisis, we think about investment banks. But investment banks were not all bad. When acting properly, they played an important role in our economy. They help channel the nation's wealth into productive activities that create jobs and make economic growth possible, bringing together investors and businesses and helping Americans save for retirement or a child's education. Everybody wants the American dream of owning a house with a white picket fence, a dog, and a couple of kids running around gleefully in the yard. This dream is closer for some than others, and some are willing to do whatever it takes to make it happen. It is whether the ethical standards of the bank will tell you no if you need to hear it or give you a loan that you can't afford. I feel the worst decision that the investment banks made were that they were lax on the requirements to get a housing loan, creating subprime loans to more and more people. They took these subprime loans and repackaged or securitized them into mortgage-backed securities. These mortgage-backed securities were filled with loans rated from AAA to unrated. Historically, MBSs were of low risk with a high return, so investors did not see the harm in continuing to purchase shares. As the housing market dropped, the banks were giving people with bad credit and low income loans that were far beyond their means. These loans were bundled in with the AAA mortgage-backed securities, creating a higher rated tranche that more investors would buy shares of. Banks saw how many were coming in, so they took the current mortgage-backed securities and bundled them to create CDOs, or collateralized debt obligations, a mouthful. When the investment bankers relaxed on the requirement for loans, more people went in to get a small bank loan and came out with one that was well beyond their means, like I mentioned earlier. The banks knew that there was a chance of default, but that didn't seem to matter to them, since the money that they would make would be greater. The biggest cost was when the housing market crashed, the houses that had subprime mortgages defaulted, and thousands lost their homes. The banks had bet against the housing market, so when the bubble did burst, the money came flowing in. The definition of stewardship is taking care of something, like a large household, the arrangements for a group, or the resources of a community. The investment bankers violated the very definition of stewardship. Looking at the four principles of biblical stewardship: ownership, responsibility, accountability, and reward, these banks took advantage of people in each of these principles. People wanted to own houses, and the banks had the ability to make this happen. The principle of ownership is to understand that God owns everything, and we are mere managers or administrators of these things. The banks showed that they could overpower God by controlling who and when people could get housing. Responsibility and accountability work hand in hand in this situation. The responsibility the banks had to be honest to borrowers that they could not afford large loans was lost, and in the end, only one person was held accountable for the housing crisis and went to jail, when it was hundreds of people on each level that broke this trust. Reward is a tricky principle. From the bank's viewpoint, they won. The reward was great. They bet against the market collapsed, and they were rewarded with millions and billions of dollars. The reward that they broke was that of the people they bet against. The person that had a house, thought things were okay, and then within a year was on the streets bankrupt because of these banks. The managerial finance principles that were violated include the cost-benefit principle, where the benefits are greater than the cost of the financial decision. In this case, they made the financial decision the top priority over what the benefits could be. The risk-return principle, where the probability of the deviation of the plan creates more risk. The typical course of securing loans was very much deviated from when the investment banks reduced the requirements for the loans. Lastly, the time value of money principle. The passage of time affects the value of money. This crisis started in full swing in 2007 and over time became worse. In 2008, when the housing market crashed, it could have been stopped or at least slowed down by one of these people involved, but money talks and it was yelling at them. So how could the banks take action to reduce the severity of the crisis? The banks should have been honest, first and foremost, about the rating of the mortgage-backed securities, being transparent that the AAA rating they held was made up of B and BB loans. The big financial institutions stopped buying subprime mortgages, and subprime lenders were getting stuck with bad loans. By 2007, some really big lenders had declared bankruptcy. Banks also should have kept their lending requirements the same and not become lax on who they lend money to. This sounds harsh, but not everyone can afford a large loan and a large house. It was the banks that convinced these borrowers that they could, knowing that they would likely default on their loans. This leads to betting on the housing market. When they lowered the requirements and know that the defaults are inevitable, they bet against these, hoping that they would default so they would make more money in the end. If they would have kept the requirements the same, the betting would likely not have happened. There is not much that the banks did correctly in this whole situation. They broke the trust of Wall Street, broke the trust of the investors, and took advantage of thousands of people. Since the crisis, the Securities and Exchange Commission, or the SEC, were looking into the horribly performing securities to see if security laws or rules of fair dealings were violated by firms that created and sold these mortgages, from the New York Times. There had also been a law that was passed that will prevent this from happening again. The Dodd-Frank law requires banks to have more transparency throughout the process and inform buyers of the risk involved in the type of loans they are getting. The Troubled Asset Relief Program, or TARP, was a $700 billion government bailout that was designed to stabilize the country's financial system. I think Alan Greenspan said it best, that if they are too big to fail, then they are too big, meaning the investment banks of New York thought that they were immune to failure and willing to risk people's lives on it. Thank you for taking the time to learn about the investment banking viewpoint of the 2008 subprime housing crisis. There's tons of information out there about the subprime housing crisis. These are the resources I used for this presentation, and I encourage you to go out there and learn more from your viewpoint.